Hi everyone, it's great to see so many of you in person today at the Congress. Just like to apologise in advance that I sound a little huskier than normal because I was at Glastonbury at the weekend and I think I got a little bit carried away at Diana Ross. But just to introduce myself, so I'm Clare, I'm a financial wellbeing analyst at Hargreaves Lansdown, and I'm responsible for the direction of HL's financial wellbeing proposition for our workplace clients. So that does include content creation, which is driven by our member research and analytics. And my background is in delivering financial education, and that's across the UK to pension scheme members, which involves sitting down with them one-on-one to discuss their financial health and also answer any queries that they have. And it's really that grounding that's enabled me within my new role to really understand member concerns, their curiosities, and what drives them to engage. But that is enough about me. We're going to jump straight into the more interesting stuff, which is why you're here. Hopefully there'll be a minute or two for Q&A at the end. So before we start delving into personal finance statistics, I'm just going to explain how we at HL view financial resilience. We'll then explore what's going on in the wider economy and the impact that's having on the nation's financial resilience. And the pandemic has changed the way we live, how we manage our money, and the way in which we work. So hybrid working looks like it's here to stay, but actually is it the best of both worlds, and what impact is that going to have on our household finances? And then last but not least, I'll explore the role of financial wellbeing in enhancing the employee experience. You'll be glad to hear that some of our findings won't cost you a penny, they will just require a company commitment. So financial resilience is now more important than ever, and that's because the pandemic and cost of living crisis have really highlighted the need to be able to withstand income shocks both in the short and long term. So knowledge really is power. It's key to people managing their money well, and actually in order to manage money well, those who can't or won't take financial advice need access to expertise and tools. And actually, that's why we at Hargreaves Lansdown have created our 5 to Thrive initiative. So we've democratised our financial advisory division and we've created an educational resource. So this is a holistic, simple framework that enables people to boost their financial resilience regardless of age, background or financial expertise. And it can be referred back to time and time again to enable people to get a steer on their financial resilience. So a lot of time and resource has been spent building this framework and not just HL expertise. We've actually been through peer review, peer challenge and a sounding board that includes expertise from Legal & General, the DWP and the Money and Pension Service, just to name a few. So not only have we created this framework for informational delivery, we've actually gone one step further and we've built out a way to measure the financial resilience of UK households across the UK. So it's all part of one big project, and that's known as the HL Savings and Resilience Barometer, and I will come on to that in a couple of slides' time. But there are 5 key building blocks on the road to financial resilience. So you can see that we've got control your debt, then protect your family, then you would save a penny for a rainy day before moving on to planning for later life. And then the final stage, once you've teed up all 4 before, is that you'll be looking to invest to make more of your money. Now, broadly, we can split those 5 pillars into 2 categories. So pillars 2 and 3, that's protect your family and save a penny for a rainy day, they are about reducing risk. That's both everyday risk, but also the sort of disastrous risk that all of us in the room would very much like to avoid. Then the final 3 pillars are all about building a better financial future. Pillar 4, in particular, of course, includes pension planning, but it can also be open to interpretation. So it would include building a house deposit if you're not yet on the property ladder, or saving money in an ISA for a more medium and long-term objective. Now, one of our key observations through all of our research was that too often individuals look at aspects of their finances in isolation. So one household may be paying a sufficient healthy amount into their pension, but be putting absolutely no money away for a rainy day, and that leaves them really vulnerable to any fluctuation in incomes or the unexpected. So this framework takes it back to basics. It allows people to target and, more importantly, prioritise. So it gives them an order in which to prioritise their key aspects of finances. And actually, it's really resonating well with our clients. To understand the pressures and pain points of employee finances, we need to take a step back and look at what's going on in the wider economy. So firstly, we had awful April, which introduced increased national insurance and escalating energy bills. Then we had miserable May, which brought about record high inflation at 9.1%, as well as pretty terrible weather. And unfortunately, the future forecast continues to look gloomy. So life is getting more and more expensive. That headline inflationary statistic doesn't show the true reality, because the cost of many essentials are much, much higher. There's a difference, for example, depending on what you like to eat for breakfast. So if you're like me and you like low-fat milk on your cereals or porridge in the morning, then that's up 16.1%. However, toast eaters have only seen a hike of 5% on bread. And if you like to wash it down with a cup of tea, then you're faring much better than those that like coffee. Unfortunately, things are going to get worse before they get better with the expected increase in the Ofgem energy price cap in October. So typically, if utilities increase, then people will look to cut their food costs. But unfortunately, with those rising too and escalating fuel costs, people are rapidly running out of places to turn. Now, there will be pressure irrespective of earnings levels. So women, the squeezed middle, those on lower household incomes, and also those with disabilities are already reporting concerns about how they're going to continue to pay their bills. So the squeezed middle in particular are already spread across their mortgage, childcare, and they may be managing on less if one of the partners is working part-time. In comparison, those in the younger demographic, they may be less concerned about rising utilities or food essentials if they're still living at home with their parents. The rising cost of essentials has important implications for our emergency fund. So actually, given the pace of inflation, we need to ensure that people are reviewing their emergency funds, that sum that they've saved for the unexpected will still buy them 3 to 6 months worth of essential expenses. To give you one slight positive, 3/4 of us have learnt a money-saving habit over the last few months, and we're certainly going to need it. So interest rates are rising at the fastest pace for 30 years, and already 10% of households are reporting that debt and low repayments are a heavy financial burden. Now, that's up on last year, and we expect it to increase moving forward as we get deeper into this cost of living crisis. Step Change, a debt charity that we work with, found that those already facing financial difficulty are using credit as a safety net. So they're using credit to buy and fund their everyday essentials. The most exposed are those families with dependents, but also those with ongoing health concerns. And this is a significant problem because those who are on lower incomes, once they get into debt, they find it much harder to control. So you hear a lot about the moments that matter, that engagement will occur at a milestone age or a key life event. But actually our research shows that it is much, much broader than that. So we actually think that the industry and employers need to be always on engagement because there is no silver bullet or one-size-fits-all approach. Actually, we think that engaging with your financial resilience can be influenced by multiple factors. So it can be influenced by age, social mobility, your salary, occupation, also where you live in the country. So let me bring that to life with an example. So my 30-year-old friends who live in Bristol and London are much less likely to engage with Pillar 2 on our framework, Protect Your Loved Ones, because many of them don't yet have houses and many of them don't have dependents. They're not going to be bothering with life insurance perhaps yet. In comparison, my other friends who decided to remain in Devon after school and build their life there, they do need life insurance because they do have mortgages and dependents. So I think it's really important that we remember that life stages happen at different speeds and everyone's trajectory can be really different. So there is no silver bullet or one-size-fits-all approach, and therefore we need to ensure that we keep this holistic framework of financial resilience. And therefore, by delivering broad financial education, that means that you're going to be catering for all, and that's particularly true for nationwide companies. So the rising cost of living will have an obvious impact for perhaps delaying our finances and delaying moments that matter for employees. Some employees may have to tap into their house deposit to fund ongoing bills. For others who've got 2 children, life just got incredibly more expensive. They might have to delay uplifting their pension contributions. In order to drive financial well-being, it's important that we don't get hung up on the assumptions around moments that matter. So whilst important, I think we need to be realistic that employees will engage when they want to and when the time is right for them. So therefore, the challenge for us is to always be on engagement, to make sure that we are going to turn that interest into action. And we can facilitate that through either financial education, round-the-clock apps, we can do it through innovative technology and interactive calculators. So we need to make sure that as soon as there's interest, we are turning that into action and making it as easy as possible for members to engage. A repeated observation is that people always think they'll have more money to build their financial resilience at a later stage in life. So in your 20s, you think you're going to be richer in your 30s, and in your 30s, you think you'll have more money to build your resilience in your 40s. It's always the same regardless of the scenario, but the reality is typically you might be income richer, but your expenses will expand to grow with that. So we need to make sure that actually financial education happens at the earliest point possible, and using a framework like our 5 to Thrive does show you that actually individuals need to balance both their short-term wants with their longer-term needs. Any of you in the room that are HR professionals, I'm sure have been working through the challenges of hybrid working for what feels like forever. So I'm going to keep this to the personal finance statistics. But enforced home working throughout the pandemic, of course, removed many of the barriers to flexible working. And 4 in 5 people said it's improved their work-life balance. Actually, we think that there's been a profound shift in parenting roles. We've seen much greater responsibility for childcare across male and female partners, and that has huge potential for women returning to the workforce, taking on longer contracted hours and applying for more senior roles, all of which will have long-term benefits for both the gender pay gap and the gender pension gap. So research in January showed that 46% of people home working spent those who are home working spent 46% less overall. And actually, we've seen a shift in terms of the framing of essential expenditure. So actually, home workers spent 86% more on utilities. Bear in mind that expected Ofgem energy price cap coming later in the year. But they spend 50% less on commuting by car and 40% less on public transport. So in this increasingly expensive climate, there is an argument that employees will need to rein in their spending as bills increase. Some, come October, may need to choose between heating and eating. So one obvious way for them to cut costs is to work from home and perhaps increase the amount that they're doing that. The new world of work is here to stay, with the ONS reporting that 23% of companies now want to include home working permanently. That's up 16% from 2020. Those people that are hybrid workers, so splitting their time between home and the office, need to ensure that they're not going to end up with additional costs, so that they're not paying to heat their home permanently, whilst also paying to commute or pay for parking on those days that they're not travelling into the office. So it's important that if that is becoming part of their permanent contract, that they need to make those life admin allowances to make sure that they're not going to end up with additional costs. For employers, one downside of hybrid working is the impact on staff loyalty. So if individuals are working from home and they may feel less involved in that work community, it can diminish their attachment to an organisation. One way to combat that is to make yourself a more attractive employer, and you can do that through your benefits package. So something that we've been thinking through recently is how can we drive financial wellbeing within the Bristol community. So we've been defining what we think makes a financially resilient employer. And I thought it would be a really good opportunity to share that with you. So applying a lens to that same 5 to Thrive framework, we've identified some key areas where employers can make a real pivotal difference to shaping staff resilience. So I'm going to talk through a couple of examples. So starting with pillar 1, so controlling debt. Through our work with Step Change, the debt charity, we were really surprised to learn about the significant number of individuals that are plunged into debt due to payroll errors. So it's really awful that people that are living paycheck to paycheck are being plunged deeper and deeper into debt through no fault of their own. So actually, we think one thing to do that would cost nothing to the company is just to ensure that you sort payroll errors within at least 1 week. Pensions come under pillar 4, so offering anytime pension contributions makes it as easy as possible for your members to engage with their pension and later life planning. The flexibility ensures also that they feel secure that if their income does fluctuate, they've got that flexibility to change their contribution should they need to. I have worked with a handful of employers in the past that do restrict contribution allowances and changes to a couple of times a year, and that will be due to the admin requirements. It is a major deterrent to engagement with pension planning. If you're talking to a client and you realise running through a projection tool that they are far off their desirable income in retirement, and they say there and then they're happy to uplift, and you inform them they'll have to wait 4 months until the next allowance change, the likelihood is that we're not going to be able to convert that opportunity. So actually, we need to make it as easy as possible for them to build their financial resilience. Financial education, of course, will bring these 5 pillars to life. So they'll importantly help employees understand how that mix of products will enable them to build their financial resilience and give them peace of mind. All of you here in the room are decision makers, so you do have the power to start steering tens, hundreds or thousands of individuals' financial resilience in the right direction. So Make sure what you're offering through your benefits package does address resilience across these 5 pillars. And actually, we know that financial anxiety is one of the biggest causes of stress, and that stress impacts productivity. So by helping them build their resilience, then it is win-win for both parties. So at the beginning of the year, in partnership with Oxford Economics, HL launched the Savings and Resilience Barometer. So this is a nationwide data set which will give insight on the financial resilience of households across the UK, and we're measuring it against those 5 to Thrive pillars, so it is all one big project. Now, we hope that this data set will provide insight to decision makers like yourselves in terms of how your employees are faring and just how to build your benefits to make sure that you're addressing their needs. But we also hope that it will be used to inform policymakers where the need for change lies. So initial results came out in January, and they revealed that just 4 in 10 are on track to receive what we define, well, the PLSA defines as a moderate retirement. Now, actually, we know that those in the South East and those in Scotland are leading the pensions pack, whereas those in the West Midlands, they are the ones that have the biggest pension problem. A third of the UK don't have access to 3 months' worth of rainy day money for their essential expenses, and I'm sure a few of you in the room will be surprised to hear that includes 1 in 10 of the top earning households in the UK. So I'm sure many of you might be sat here thinking that your top earners, actually, surely they've got enough cash saved away for emergencies, but that isn't the case, so 1 in 10. Now, the reality is when people earn more, their outgoings expand to reach that, and for top earners, if they've got children in private school or if they have a large mortgage as well as a top-end car, it's not unreasonable to assume that their emergency fund might need to be around £20,000, which is a huge sum. They might think that's too much, and they might also balk at holding that in cash. So actually, this really just reiterates that there are going to be challenges regardless of income level. The data set is biannual, so the next edition is out next week on the 5th of July. I've had a sneak peek, and it is pretty scary stuff. So although I can't share too much, the stats are really quite shocking. That's coming from me, and I read the stats on a daily basis. So over the last 3 months, the cost of living crisis has escalated, and that's revealed that 41% of households are now using savings or borrowing to fund their essential expenditure. We actually think that the escalating cost of living crisis is enough to almost offset all of the gains that were made during the pandemic through forced saving. So actually, we're going to see a drop in equality in terms of financial resilience. There is increasing pressure being placed on household budgets, and without the right money management skills, more and more employees will struggle to make ends meet. It is pretty dire, but things might turn desperate. So I personally have noticed when I'm doing my weekly food shop, I've noticed over recent months more and more families going up and down the aisles with their phone calculators out. And then they'll get to the checkout and they'll say, please stop at this monetary amount, prioritising stuff at the front of the belt. So correct money management skills and improving those are going to be fundamental to helping people get through the next few months and perhaps the next year or so. But nobody will escape unscathed, though there is that particular concern for those low-income households. And if you sign up to our mailing list via the QR code, which will appear on the next slide, or via the Hargreaves Lansdown stand, then we will send you a full copy of that report next week when it's out, so it'll be hot off the press.